It's simple. If you don't own assets, you will fall behind. The system is structurally rigged against those who work for their money rather than own things that make them money. Put another way, you don't really have a choice whether you invest your money or not. This isn't a quote from me. It isn't a quote from some rich guy that owns a lot of assets. This is the data. This is what the facts are saying. Here's 7 reasons why you must invest your money using data. Over the last 30 years, if you invested in the S&P 500, just a collection of the biggest stocks in the United States, you'd have 19x your money. In the meantime, if you held cash, you'd have lost 50% of that value. $1 30 years ago is worth less than 50 cents today. How does that happen? It's still the same dollar bill, the exact same dollar bill that's printed today. An example that might hit home for you, gas just 30 years ago was about $1.24 per gallon. Today, it's roughly around $3 to $5, somewhere in that range. In any case, we're up like 300%. If the price of gas has 3x'd, your $1 has 67% less purchasing power now than it did back then. Inflation, not exactly a profound concept, but easily the best argument for investing your money right now. This purple line right here shows us the total wealth owned in the United States by just the top 1% of people. We're not including 99% of the population. This blue line down here represents the total amount of wealth owned by the bottom 50% of the population. What will you notice? Well, the bottom 50% of the population, yes, that's right, 50% of the people in the United States, they account for roughly 3% of all the wealth. The top 1% account for over 30%, 10 times as much. You also notice that the trend seems to be going up for the purple line. The trend for the blue line seems roughly down to sideways. Why does it appear like this gap is only getting wider? How is this even possible to begin with? Well, it comes down to basic math. You know that whole saying, the rich get richer, the poor get poorer? Well, that boils down to a very simple fact. This blue line right here shows the average wage increase across the United States. You'll notice on good years, you're looking at roughly like a 5% gain here. A 5% raise, that's pretty good. The purple line represents the S&P 500 yearly return. It's a lot more volatile. You even have some really bad years during the great financial crisis of a roughly 35% pullback, but you also have some really, really good years. In either case, the high end is usually a lot higher than any raise that you might get. There's very few instances where we see wage increase outperform the S&P 500. And why does that matter, and what does that have to do with the wealth gap? Well, wealthy people own assets, and the more assets you own, the faster your wealth goes up. This right here shows the money from your job over time. If you started at $100,000 in salary and got a raise corresponding to this line every single year. So this year, you actually would have lost some money on your salary. This year, you would have gained some. This year, you would have gained a lot. You get the point. This purple line represents if you just invested in the S&P 500 and didn't look at it for 30 years. You can see by the end of this time period, you're outperforming your salary by roughly double. But remember, this is just purely if you invested $10,000 30 years ago. What if instead of that, you took some of your salary and invested that into the S&P 500 every single year? You can see things start to get even more crazy. Your money from investing $10K every single year and getting that S&P 500 return, you're sitting at roughly $5.7 million, well above any salary that you probably would make at this point. Obviously, there are other things we aren't considering here, like taxes, inflation, etc. But simply put, the wealthy own assets, and those assets appreciate much faster than any salary you're going to own over your entire lifetime. Businesses win, not people. And that sounds weird. You'd think, well, ChatGPT, it helps me write essays. It helps me cheat on exams. It makes me more productive. It does a lot of stuff for me. That is true. However, you being more productive and efficient doesn't necessarily mean your net worth or income goes up. However, a business that gets more productive, gets more efficient, saves money by cutting jobs, cutting you from their workforce, that just means more profit for them. And more profit generally means stock go higher. Again, don't believe me. Jensen Huang, CEO of Nvidia, the biggest company in the entire world by market cap right now, says he would be deeply alarmed if his $500,000 engineer did not consume at least $250,000 worth of tokens. What does that even mean? To simplify this, tech companies, specifically companies using AI models in some way, are including the token usage that you're gonna get in that position in their job applications. That means we're starting to base the decisions we make, these companies make, off of how many tokens employees are actually using when they do their work. Is that a dangerous path to go down? Yeah, potentially valuing just artificial token usage instead of the quality product at the end of the day. Yes, those two things can coexist, but I'd argue right now tokens aren't used as effectively as they could be. The amount of tokens being consumed is exponentially growing. Claude just saw like an 80x over the past 3 months. It's absolutely ridiculous. And you gotta understand, as businesses continue to use tokens more effectively, more efficiently, more productively, the cost to do something that used to take, like $200,000 software engineers a month to do is naturally going to come down. And if the cost to do that something goes down, let's just assume revenue stays the same, then that means profit goes up. And you could argue as AI gets better, as businesses find out better and better ways to incorporate it, then their revenue might go up, not just stay the same. And if that's the case, then you could imagine that profit is going way up. What does all this mean? Generally, stock up. Of course, this is all in theory. On an individual level, we could debate all day if companies are actually getting the most out of AI right now. We have reports that every 20 cents used on AI tokens ever ends up reaching the end product. A lot of it's just spent on rework and addressing bugs that were introduced. There's reports now that AI actually costs more than human workers. So again, this stuff is debatable whether the profit will come or not. But the point is, it doesn't matter. Big tech is spending every single dollar that they make and more to build out their AI data center infrastructure. And there's nothing you can do to stop that. All you can do is reap the rewards, you guessed it, in the stock market. This one, a very similar point. AI cuts jobs, potentially puts you out of a position, but that means if unemployment goes up, we need to make up for that money that would be made by those people somewhere, and that's probably going to be realized in the stocks taking that value from people. Is this a good thing? Well, obviously not if you don't want robots and AI to take every single job that exists on this planet. But over the long term, it should open up value opportunities elsewhere. You put people out of jobs in the short term now to hopefully open up more meaningful and value creating jobs. Again, is that going to happen, or is this a whole lot of BS? Let me know what you think. CEO of Anthropic has told us that Anthropic and other AI tools could eliminate half of entry-level white-collar jobs and spike unemployment to as much as 20% in the next 1 to 5 years. I'm sure you remember the last time it was near that rate was COVID, which was due to a health emergency, not necessarily AI voluntarily taking all the jobs that we have. Now again, is that even true? Will unemployment spike to 10 to 20%? Will half of all white-collar jobs disappear within the next 5 years? Sure, that could all happen, but now we're starting to see them walk back those opinions. Sam Altman saying he's happy to see that he was wrong and jobs aren't going to be as impacted as he once thought they were. Now you tell me, is it part of their strategy to hype up that unemployment's going to skyrocket, everybody's going to lose their job, there's a mass unemployment apocalypse, so that people will invest in their stock because that's who's creating all the value and taking all that money? Maybe. That could be it. But we're not here to speculate. We're here to look at the data. And either way, I'd argue investing in companies that are creating value through artificial intelligence is almost a direct hedge to an unemployment spike. Obviously, there's a lot of caveats there. Things could go horribly wrong if the unemployment rate spikes to 20%. The economy would be very nervous, but it's a hedge nonetheless. This number right here, this 39 trillion, by the time you see this video, it'll probably be higher than this. This is the total national debt of the United States. Roughly $114,000 of debt for every single person that lives in America. Why does U.S. debt matter to you at all? Doesn't matter where you're from. Maybe you're not from the United States. Maybe you're not investing at this point. Maybe you are investing and still don't understand why debt matters. The U.S. economy is inflationary by default. Ever since 2008, the great financial crisis, the government relies on printing money to prevent big problems. Oh, lenders are giving out mortgages to people who don't have a job, who clearly can't make this monthly payment to pay off their house? Print money. The government completely shuts down the economy and forcefully closes all businesses in hopes to not spread any virus across the world. What do? Print money. Stock market goes down, print money. Stock market goes up, print money. Tough day at work, print money. GTA 6 comes out, yes, even that, print money. The point is, no matter what, this financial system is based on inflating debt away. Number one, we talked about how you have to invest to make sure you don't lose all your money due to inflation, reducing your purchasing power, right? That $1 in March of 1995 is now worth less than 50 cents today. The same thing, the same exact dynamic happens with debt, except that's a good thing. If inflation is up, stays higher for longer, that means the debt burden, the amount of money that you owe 30 years down the line, is going to be lower, because 30 trillion today is worth a whole lot less 30 years from now. And what does this also mean? Well, you guessed it. That means if debt gets cheaper, then companies taking on a lot of debt to do all these cool things, to buy new AI chips, to buy the biggest and baddest AI facilities, that debt gets cheaper with time, allows them for more AI capability now, better products, better services. With better products and services, more people buy. That means more profit. That means stocks go up. Now, what I'm not saying is you want prices to go up 200% a year so your debt gets really, really cheap, really, really fast. That just cripples everybody. Then you can't buy bread from the grocery store. The point is, you want a healthy level inflation that encourages businesses to drive down prices, to become more competitive, and so consumers can spend more money on their products and services. It leads to a positive feedback cycle of innovation, technological disruption, profitability. Everybody's happy if you're invested. I'll just give it to you flat. If you were to buy stocks that the US government invests in, then you'd be doing pretty well for yourself. Intel, a company that manufactures AI chips, dead in the water, doesn't do anything for like 30 years, gets a deal from the US government here. And yeah, I think you can see the trend here. Same thing with Nvidia. Basically, any company that they announce a partnership with goes straight up. A little different because that's a company making its own decision, not the US government. But the point is, you go where the money goes, and the money isn't going to cash unless you're Warren Buffett, of course. The money is going to the companies that are the key players in the AI industrial revolution. Now, normally, the US government in a capitalistic economy doesn't invest in private companies because that goes right against capitalism. I mean, it makes the space potentially anti-competitive. You know, if you're giving Intel like $1 billion here and there just to help them out, make sure that they have a horse in the race, well, that probably makes other chip makers not too happy because they're not exactly getting the same funding. Is that fair? We could debate this all day long. Of course, when it comes to very important technology like artificial intelligence, you don't exactly want that in the hands of bad actors that are going to create, nuclear weapons a lot faster or hack everybody's passwords and steal all their crypto. Of course, there is some merit to both sides here. You also don't want to rely strictly on international supply chains, so you don't get a whole Strait of Hormuz situation where one line gets cut and all of a sudden the entire AI build out is in jeopardy. You don't want that. That cripples the economy, that cripples the stock market, and hurts your money, obviously. So in conclusion, if the United States, the biggest economy in the world, with by far the biggest stock market on the planet, is willing to invest in their own stocks, I think you should be too. This right here is a chart of the stock market over the past 100 years, from roughly 60 to 50,000. So I'm not really sure there's much else that needs to be said here. Generally speaking, the stock market in the United States goes up. That's in large part due to it being the global reserve currency of the world. It has a lot of control, a stranglehold more or less, over the financial system in general. Stock markets don't always go straight up. If you invested in the Japanese stock market 35 years ago, you'd just be now breaking even on your investment. So obviously, it depends where you invest. And the reason investing in the United States has been so historically successful, like we said, they have a stranglehold over the financial system. Is that fair? Life isn't fair, and the financial system will never be fair. I can promise you that. But this leads into the conclusion of our video. It's perfectly reasonable to put cash away in the S&P 500, the NASDAQ, whatever basket of stocks or equities represents the companies and countries that are dominating the global financial landscape. That is always a viable strategy. However, for those of you that want to be more actively engaged with your investing journey, to make investing decisions that are based on data, I have something that I know you'll appreciate. Now, I can tell you right now, this isn't going to be for everybody, but those who want to get an edge over the stock market using data, no matter how much experience you have, little to no experience, some experience, a ton of experience, it doesn't matter. This app right here, www.marketspredictor.com, is automatically testing tens of thousands of strategies in the stock market today, right now, every single day. What does that mean for you? Well, that means all these strategies are going to be displayed for you, very intuitive, easy to understand, and you can literally add to your portfolio to track in real time whenever this strategy triggers again. Obviously, you don't have time to test tens of thousands of strategies against the stock market. Nobody does. We all have lives. This system's going to do it automatically for you and spit out the best possible strategies for you and notify you when there's a buy and sell signal. Obviously, past performance is not indicative of future success, but if you're even more ambitious, you can try out your own ideas. Again, you need very little experience. You just have to come over to the AI chat. Jimmy is going to help you out. He's our expert. Maybe you think that NVIDIA tends to outperform, go up, however you want to put it, before earnings. So all we're going to do is ask exactly what we have a suspicion about, whatever that hunch is. How does NVIDIA usually do in the 30 days leading up to earnings? Basic English. We're just typing it out, and within seconds, you're going to get a summary of what this signal usually gives you over a 1, 5, 10, 30-day time frame. And if you want to see more data, you can see full results here and get a nice summary of what you can expect over time. Again, very intuitive. You don't need to know all this fancy financial or mathematical jargon. All the statistical stuff is handled for you. The summary page is the easiest way to read. But again, if you're more ambitious and want to unlock that deeper edge, you can go into these other tabs that explore more deeper into what kind of edge and how you could optimize this strategy for even more edge. What regimes, very bearish, neutral, very bullish environments, when these signals actually occurred, what all these outcomes looked like. These are the things that are going to take your strategy from good to great. And by the way, based on the data, that NVIDIA 30 days before earnings has been a phenomenal edge over the past 7 years. And this is a very common market phenomenon known as earnings anticipation. Traders start to price in the good news before it happens, but you wouldn't know it until you test it, obviously. So overall, based on the data, investing in the stock market is an absolute non-negotiable. And my goal is to give you a tool that allows you to take advantage of the stock market using data. Not just guessing or gambling on what stock's going to go up next because of XYZ. Those things matter, the fundamentals matter, but you have to understand the stock market is just a vehicle for human emotion, and human emotion is exhibited through candles. through numbers. We test all those numbers here, tens of thousands of strategies per day, spit out the best ones to you, giving you a systematic approach that allows you to control your edge. Think about it like the casino. It gives you the casino edge. You're not the gambler, you're the casino. Over time, you are going to win. You rig the odds in your favor. Again, I can't guarantee anything. I'm just an engineer. I put a lot of time into this tool to help you with your investing journey. If you do try it out, I promise you won't regret it. Comment down below and let me know what the biggest struggle point is for you right now when it comes to investing. Again, this isn't for everybody, but if you're serious about using data and using the facts to make better decisions in the market, link is in the description. I wish you the best of luck. I hope this helps, and I'll see you in the next one. Bye-bye now.